So let's break down operating working capital here. Remember, working capital is current assets minus current liabilities. And of course, operating current assets minus operating current liabilities. And so that's what we have. That's what we have here in this table. We've done one other thing, which is really common in this kind of analysis, particularly for working capital, because working capital is so focused and the accounting rules are so focused on time. In other words, current assets should be converted according to accounting rules within 30 to 60 days. They need to be converted to cash. So we need to recover our accounts receivable and we need to turn our inventory and things like that into cash. And likewise with current liabilities, we need to pay our accounts payable and our accrued wages and all those other current liabilities. We need to pay them within 30 to 60 days. That's according to accounting rules. Now, these aren't, you're not going to get sued if you don't do it within those time frames. But if the time frames go too far outside of what's set down, then we can get in trouble with the SEC and the IRS. Because of fraudulent reporting, we've reported that these were current, but we didn't actually treat them as they were current, and that's an important distinction. So, because time here is so important, one of the most common things to do is to turn all of these cash items, right, in the balance sheet. These would, operating cash would say $2 million. Accounts receivable would say $5 million. What we do is we convert those into what are called days. How long does it take these companies in terms of days to convert all of these items into cash, to clear them from their current accounts? And the conversion here is pretty straightforward. You take you can see the formula here. Take the account, the balance sheet account. So for instance, cash, $2 million divided by revenue of 40 billion times 365. So how long does it take for that cash as a percentage of revenue to turn into to be converted, to get off our current accounts? And so we're looking at it in terms of days. So if we look at this measure, if we look at this table for both of these companies, we got UPS on the left, FedEx on the right, for the 3 years, 2011, 2012, 2013, we see that broadly speaking, there's a lot of similarities. But there's also a few important differences. And this highlights why we want to go more in depth, because we see that even though at the top line working capital was similar, once we go into a little more detail, we see a couple of places for improvement for FedEx. Now, what are those differences? Well, if we start at the top, let's look at operating current assets. We see that they hold about the same amount of operating cash, and again, that's not. We wouldn't expect anything different. Both of these firms are big delivery companies. Even if they're in mostly different avenues of that business, they still shouldn't need any more operating cash than the other. Accounts receivable, they both convert their accounts receivables in about 40 days on average. It's a little bit different in each year, but it's not that different. Nothing to catch our eye here. Other current assets, again, they're converting their other current assets in about 6, 7, 8 days. Again, no big differences here. And in total, their operating current assets are about 60 days worth of revenue, 55 to 60 days worth of revenue for both firms. Again, no differences here that are highlighted on the current asset side. Now, if we look at the current liabilities side, we see a big difference right at the front, accounts payable. For UPS, they're able to convert their accounts payable in about 80 to 90 days, 82, 81, 89, right? So that's almost 3 months that they're taking to pay their suppliers. This is accounts payable. FedEx, 43 to 50 days. So either FedEx is committed to paying on time, or UPS has found a way to convince their suppliers to let them take a little bit longer to pay off. And that means they have a little bit more time to handle that cash. This is essentially, accounts payable is essentially a very low interest or interest-free loan from suppliers. And accounts receivable is essentially a very low interest loan you make to your customers. So if you are able to make loans that get paid off quickly, but take loans that you can pay off in longer time, you're going to be better off financially, right? So they're better able to delay suppliers, and that could be driving a pretty significant funding source or use of funds here, that you can have more funds available if you're UPS than if you have FedEx. Everything else about the same. Accrued wages and withholdings a little bit higher for FedEx, but by 2013 they come down to about the same level. And so 2011 and 2012 could just be an anomaly. We might want to look at that. It is something to, that catches my eye a little bit. Self-insurance reserved and other liabilities are about the same. And you see that by the time we get to the bottom, total working capital in terms of days is about the same for both of these firms. So the top line, which is total working capital, isn't that different. But once we look at the details, we might notice some things to be concerned with. Right? So ideally, again, we'd want to look at these for all of the different branches of the tree, not just working capital. We'd want to look at fixed assets as well, and then we'd want to look at some things from the margin, and we will look at some things from the margin. Only we're going to use two different companies to look at the margin, because I want to show you another tool in our tool chest that can help us analyze a company in a little different way than we might be thinking. And this tool has to do with what we call non-financial metrics. So far, all we've been using to analyze the historical performance of the firm has been financial ratios. We're looking at cost ratios and efficiency measures and profit measures and comparing these two things. But sometimes that is not enough to tell the whole story. And here's an example of what I mean. So let's look at two airline companies, United and JetBlue. And if we were comparing United and JetBlue, we'd have broken down the ROIC tree in all the same ways. And one of the things we would have seen is that JetBlue has and I'll show you the tree here in a little bit, but one of the things that we'll see is that JetBlue has an edge on United in terms of operating margin. And so in our quest to explain why JetBlue has a better operating margin than United, we'd break down the tree into all the branches. So we'd look at all the things in between revenue and operating profit, which here is going to be aircraft fuel, salaries, and other operating expenses. So I'd look at aircraft fuel as a percentage of revenue, salaries as a percentage of revenue, other operating expenses as a percentage of revenue. And actually what I would see is that all of these at the top line look pretty similar. And so what we're trying to understand from that then is, why is my profit margin better at JetBlue than United? And so we've got to go into a little more detail, and the financial information is not quite enough detail for us. So we would look at something called a non-financial metric. And what we're going to utilize to do these non-financial metrics is airline companies report some other operating statistics. Specifically, they typically give us employees or full-time equivalents, and they typically give us a very important measure in the airline industry, which is called available seat miles. So an available seat mile is the number of miles that each seat on a plane flies over the course of the year. In other words, the plane might say fly 500 miles from Charlotte to New York, but that plane has 300 seats, and the available seat mile is each of those seats flying those 500 miles. So the total plane has available seat miles equal to 500 times 300 seats. And so that's why you see these numbers being huge, right? This is available seat miles in millions, which for United means in 2013 they flew 213 billion available seat miles, and JetBlue had 42 billion available seat miles. So clearly United, much bigger. I mean, we can see that in the revenue numbers, we can see that in all the numbers. That's, again, why we're doing ratios from the start. But we are breaking down the cost measures, and one of the things that we would notice here is that salaries, which is one of the biggest cost drivers for airlines, they have a lot of really highly paid employees, salaries as a percentage of revenue is almost the same for United and JetBlue, 20% and 21%, right? So at the top line, this would seem to, we'll see these differences, or we'll see these measures being very similar, but that doesn't point out to us why JetBlue has better margins. So we'll use these operating statistics about labor to break down and go into more detail on our salaries, our labor expenses, and see if we can't find out why these two companies are different. So here's how we're going to break down labor. again, I'll give you an example in another video of the math trick here that I'm using to decompose these ratios into a bigger equation. But we're decomposing labor expenses again into 3 parts. So we're using the same trick that we used for ROIC for one of the other branches of the ROIC tree to break down that branch even further to look at more detail about and try to see what's going on here. So we'll take labor expenses to revenue and we'll split it apart into these 3 measures. Labor expenses divided by total employees. This is basically average salary. Total employees divided by average available seat miles. This is essentially productivity. How many employees does it take to fly a certain number of seat miles? Right? So maybe JetBlue uses 2 pilots and United uses 4 to fly the same number of seat miles, so it's efficiency measure. And then the last one is available seat miles divided by revenue. And this is a profit measure. This is how many miles do we have to fly each seat in order to make $1, right? And just as a hint on this trick, notice that if you multiply these 3 ratios together, the total employees will cancel out in the first 2, the available seat miles flown will cancel out in the second 2, and we'll actually be left with just labor expenses divided by revenue. That's why I say this is a math trick to decompose this, because we haven't changed anything here. We've just used a math trick to expand what we see so that we can understand a few other things. So here is at least a small part of the ROIC tree. Right? Notice that here's the operating margin part of the ROIC tree for these 2 companies. And we see that JetBlue has an operating margin that's close to twice as high as United. So they're making 7.9 cents of every dollar of revenue turns to operating profit. And United is making like 4.6 cents in profit for every dollar of revenue. So in our quest to understand why JetBlue is outperforming United in terms of margins, we deconstruct our margin. So we look at our cost, in other words, the things between revenue and operating profit, and that was aircraft fuel. We see the aircraft fuel cost here is about the same percentage-wise. United 32%, JetBlue spends a little bit more on fuel, 34.9%, and that may just be a quantity thing. United gets a slightly better deal because they have a bigger operation, so they maybe pay a fraction of a penny less per gallon on aircraft fuel, a little bit better cost structure. It could also be related to some kind of fuel hedging, and Southwest is famous for this kind of fuel hedging, so it could be something that we want to look at a little bit more. It's possibly something to look at here with a small difference in fuel costs, but probably not a big thing. We look at, especially because JetBlue is paying higher fuel costs than United, and we're trying to explain a difference in JetBlue's favor for operating margin. So then we look at labor expenses. Again, labor expense is going to be a huge thing for airlines with lots of highly paid employees, really strong unions. Certainly you can see that that's going to start playing out right now as airlines are collapsing, and we're going to see some fallout here. And we talked about already in this class, I think we talked about airline bankruptcies. And I might do a short video, we can talk about it a little more. So we look at labor expenses here. United, 22.5% of their revenue goes to labor expenses. JetBlue, 20.9%. So United has slightly higher labor expenses than JetBlue. It doesn't seem on the face of it that should be a huge driver affecting margin, but that combined with a slightly higher other costs, and other costs here are going to be all kinds of other things. They're going to be gate fees that and landing fees that these airlines pay to rent out their gates and runways and maintenance sheds and stuff at the big airports. So there's going to be a lot of other stuff rolled into other costs. If we were really doing this analysis, we'd break down other costs a lot farther here, but I'm just trying to get you an idea. So having slightly higher labor costs plus having slightly higher other costs is probably what's driving this difference in operating margin. But I just want to show you an example. Just looking at these numbers, nothing really stands out, right? And And so we want to go into more detail, even on the ones that don't stand out. So look at labor expenses, 22.5% to 20.9. That's a difference of like 1.6% in terms of labor cost. But if we look at more detail and we use these operating non-financial statistics provided by the companies to go into more detail, we can see some unusual things. So we're going to split apart labor expenses like we did. We have labor expenses over 1,000 seat miles, revenue divided by miles, labor expenses divided by employee, millions of miles divided by employee. Right? So the first thing we'll look at is labor expenses divided by total employees. This is our sort of average salary. And what you see first, right, so that's over here on the far right edge, labor expenses divided by employees. What you see first is that United pays their employees significantly more than JetBlue. Their labor expenses per employee is about $100, and for JetBlue it's 87.6. So that's a pretty significant difference. That's a little more than 10% more. And this could be because United has more stronger unions. It could be because they have longer tenured employees that just have higher salaries. We don't know exactly. Maybe it's because JetBlue probably hires newer, younger workers that then eventually graduate to a bigger carrier like United. But whatever it is, they definitely pay their employees more. We see labor expenses per 1,000 seat miles. So how much are they spending on labor costs for every 1,000 seat miles flown? And again, we see a big difference here. United is spending $40 for on labor for every 1,000 seat miles. JetBlue is only spending $26. So not only is United paying their employees more, or maybe this, but not only are they paying them more, they're also paying more to fly the same distance. Right? And what this might point out to us is that this is just a factor of because they're paying them more. Right? So JetBlue is spending a little more than half what United is in terms of labor costs to fly the same distance, the same number of seats, the same distance. And if we look at millions of available seat miles per employee, we see a sort of twofold effect is going on here. One is, for every United takes 2.4 employees to fly 1 million seat miles, and JetBlue takes 3.3. Right? So JetBlue is getting a more efficient use of its employees. Right? Its employees are flying a full third farther, and they're getting paid less. Right? So JetBlue employees are doing more for less than United, and that is driving a pretty significant difference in labor usage. Right? The ratio labor expenses to total revenue sort of misses this important thing of detail, which is that even though they're spending about the same amount on labor as a percentage of revenue, JetBlue is getting significantly more operating performance out of that labor. So they're spending about the same amount on labor, but JetBlue's employees are doing more, and they're doing it for less. Right? And that is a big difference, and that is the big driver here behind this operating margin difference. So non-financial metrics can be really important. There's lots of other different types of non-financial metrics. These are going to be different for every firm. So, I can't reuse this available seat mile ratio decomposition for Home Depot, or I could probably use something similar for UPS or FedEx. I could maybe do something like delivery miles, or maybe miles is a bad measure. Maybe it's like packages delivered, employees and packages delivered. Combining those two things could get me a sort of similar idea. But if I'm looking at a restaurant, or if I'm looking at a hospital, I'm going to be looking at all kinds of different financial metrics. So hospitals are going to look at number of patients cared for by employees and things like that. So the non-financial metrics will be very unique to the industry, to the company, but they can tell us a lot of really unique and interesting things about how the company performs and how we should be thinking about their financial performance going forward.